Central banks, interest rates, and the illusion of control, an analysis of decentralized alternatives. 1. The origins of central banking as cartel power. Central banks did not arise out of necessity to protect the public interest but as legal monopolies orchestrated by dominant private banks. Their inception consolidated power into state-sponsored cartels, diminishing the potential for decentralized, competitive, and small-scale banking institutions to thrive. Footnote: this section highlights the historical emergence of central banks as anti-competitive cartels. 2. The mechanics and motives behind monetary secrecy. Monetary authorities have deliberately obscured their practices, often enacting policy in secret. This secrecy masks intentional market interventions such as induced recessions, orchestrated collapses, and wealth redistributions from the public to elite financial actors. Footnote: this section examines the covert use of monetary tools to shape economies and enrich the few. 3. Interest rates as a misleading policy instrument. The prevailing orthodoxy, that low interest rates spur growth while high rates suppress it, is not supported by empirical evidence. Granger causality testing demonstrates the inverse: economic growth forecasts interest rate shifts, not vice versa. This undermines the foundational rationale of central banking. Footnote: this section reveals that growth drives interest rate trends, contradicting standard economic doctrine. 4. Central bank policy as a performance illusion. Central banks manufacture credibility by claiming responsibility for recoveries while shifting blame for downturns. Their marginal rate changes are symbolic rather than functional, creating a theatrical illusion of control akin to ritualistic priesthoods. Footnote: this section critiques the ceremonial and deceptive nature of rate-setting policy. 5. The real driver of economic growth: credit creation. Empirical evidence identifies credit creation, particularly that directed at GDP-generating transactions, as the primary engine of economic expansion. When credit is diverted to asset speculation, the result is inflation and bubbles, not sustainable growth. Footnote: this section asserts that productive credit allocation, not interest rates, is key to macroeconomic stability. 6. Regulatory tools over monetary instruments. Instead of manipulating rates, central banks wield power through bank regulation. Quota-based credit controls, as used in high-growth economies, have proven effective in directing lending towards sectors aligned with national priorities. Footnote: this section demonstrates that credit quotas and regulatory mechanisms offer more precise economic guidance than rate policy. 7. Reconsidering capital allocation through subsidiarity. The Prussian principle of subsidiarity, delegating authority to the lowest feasible level, provides a powerful model for financial and institutional design. Thousands of local banks, empowered to support small businesses, outperform centralized financial bureaucracies. Footnote: this section presents subsidiarity as a viable framework for decentralized credit allocation. 8. Historical case studies, tally sticks and the rise of English banking. England's tally stick system was a sophisticated public credit framework that operated without central banking for centuries. These notched wooden instruments represented legal claims and enabled a decentralized tax and monetary system. Footnote: this section revisits historical instruments like tally sticks to demonstrate pre-central bank financial innovation. 9. Anglo-Norman influence and the evolution of modern banking. The Norman conquest introduced structured finance to England through the exchequer and tally system. It also marked the birth of the English language and a dual-class governance model that ultimately shaped the common law tradition. Footnote: this section connects the Norman fiscal system with foundational legal and monetary traditions in England. 10. The Petrodollar Pact, Sovereignty for Stability. Following the 1971 Nixon shock, the U.S. pivoted from gold to oil by securing a covert alliance with Saudi Arabia. In exchange for military protection and political partnership, oil would be sold exclusively in U.S. dollars, thereby preserving dollar hegemony. Footnote: this section explores the geopolitical bargain that replaced the gold standard with petrodollar supremacy. 11. Sound money and the rule of law. A modern sound money system should link monetary creation to productive economic activity, restoring contractual fidelity and private property rights. Zero reserve or fractional systems distort this principle by backing speculation with money creation. Footnote: this section argues for a lawful, production-tethered standard as the foundation for sound money. 12. The need for constant decentralization in capitalist systems. Capitalism's inherent tendency toward concentration requires institutional counterbalances. A steady infusion of small community banks and decentralized credit institutions can preserve entrepreneurial access to finance and avoid systemic monopolies. Footnote: this section advocates structural decentralization to counteract capital consolidation. 13. Redefining government intervention through institutional design. Effective governance must abandon Soviet-style micromanagement in favor of shaping rules, incentives, and structures that empower market participants. The goal is not command but cultivation, enabling capitalism to flourish without central coercion. Footnote: this section reimagines government intervention as structural facilitation rather than economic micromanagement. 14. Conclusion: decentralization as natural law compliance. Systems that align with human nature and the dynamic structure of knowledge outperform those built on central command. Decentralized banking, subsidiarity, and localized control reflect the truth that, as Francis Bacon observed, nature, to be commanded, must be obeyed. Footnote: this section concludes that decentralized institutions better conform to the organic laws of information, risk, and human incentive.